When you open your banking app and see a balance, your brain imagines something simple. Somewhere, behind a locked door, your money must be sitting there, waiting for you. But that picture is not really how modern banking works. Your balance is not a private pile of cash with your name on it. It is a promise, a claim, a digital record inside a much larger machine. The moment money enters a bank, it begins to move through layers most people never see. A small part may stay available for withdrawals, but the rest becomes fuel for loans, payments, investments, and obligations. That does not mean the money disappears. It changes form. It becomes a mortgage that helps someone buy a home. It becomes credit for a business. It becomes part of a payment chain that allows salaries, rent, cards, transfers, and entire supply chains to keep moving. The strange part is this: the number you see feels still, but the system behind it is always moving. And once you understand that, a bank account stops looking like a box. It starts looking like a living network. Most people think banks store money, but banks mainly transform money. They take deposits, create claims, issue loans, manage payments, and balance timing. They connect people who have money today with people who need money now and promise to repay later. That is the hidden engine. When someone takes a loan, the bank is not simply handing over a dusty stack from the back of a vault. It is creating a new financial relationship. One side becomes an asset for the bank. The other side becomes a liability. And your deposit is part of the trust that allows that structure to exist. This is why banking is powerful. It allows an economy to grow faster than if everyone had to wait until they physically had every coin in hand. Home can be built before the full price is saved. Businesses can expand before every sale arrives. Salaries can be paid, suppliers can be funded, and ideas can become buildings, vehicles, machines, and services. But power always comes with fragility. Because when money becomes promises, the system depends on one invisible thing more than anything else: confidence. A bank can survive many problems. It can survive bad loans. It can survive slow payments. It can survive temporary losses. But it struggles to survive a collapse in confidence. That is because banks do not keep everyone's money waiting in one place. If every depositor tries to take everything out at the same time, the system faces pressure. Not because every balance was fake, but because those balances were connected to loans, assets, payment chains, and future repayments. Banking works because not everyone needs all their money at the same moment. It is a coordination system built on timing. Your rent payment, someone else's salary, a business loan, a card transaction, a mortgage repayment, and a merchant settlement may all be connected through layers you never touch directly. On the surface, a payment can feel instant. Underneath, it may pass through clearing, settlement, liquidity checks, and institutional obligations. The magic of modern finance is that it makes all of this feel invisible. The danger is that invisible systems are easy to misunderstand. There is another layer most people do not think about. Even when your balance looks the same, the value behind it can change. Prices rise, interest rates move, loans expand or shrink. Banks become more willing to lend or more cautious. The speed of money changes, and suddenly the same balance can feel stronger or weaker in the real world. This is why money in a bank is not just about storage. It is about access, timing, trust, inflation, lending, regulation, and risk. Some systems exist to protect depositors. Some systems exist to provide liquidity when banks are under stress. Some rules are designed to stop one institution's problem from spreading through the whole network. But protection does not mean the system is simple, and it does not mean every layer is equally safe. There are banks, payment platforms, funds, lenders, digital wallets, and shadow channels all moving value in different ways.
It seems to sway.
Some are tightly supervised.
Is this digital gold?
Some sit
So it goes
further
deep.
away from the center.
Safe.
To understand money, you have to look beyond the balance. You have to look at the layers. Think of your bank account like the visible tip of an iceberg. The part you see is simple: a balance, a card, a payment, a transfer. But below the surface is a huge structure: reserves, loans, settlement systems, liquidity flows, risk models, credit cycles, confidence, and regulation. The system is not evil because it moves money. Movement is the point. A completely frozen banking system would be useless. Money needs to circulate so businesses can operate. People can be paid, homes can be financed, and goods can move. But a system built on movement must also be watched carefully. If too many promises become weak, pressure builds. If liquidity dries up, even good institutions can struggle. If confidence disappears, people stop waiting their turn and rush for the exit. That is when banking stops feeling boring. It becomes one of the most important systems in the world, because the modern economy does not run only on cash. It runs on trust that cash will be available when needed. So, is your money really sitting in the bank? Not in the way most people imagine. Your money is partly a record, partly a claim, partly a promise, and partly a moving piece of a larger financial network. That may sound unsettling at first, but it is also the reason modern economies can grow, lend, build, hire, trade, and recover. The real question is not whether every unit of money is sitting still in a vault. The real question is whether the system can honor its promises when people need it most. That is why confidence matters. That is why liquidity matters. That is why banking is more than buildings, vaults, cards, and apps. Behind every simple balance is a chain of trust connecting strangers who will never meet. A worker gets paid because an employer's payment clears. A store survives because credit arrives before revenue. A family buys a home because future income becomes usable today. And your quiet balance is part of that moving machine. The next time you open your banking app, look at that number differently. Do not imagine a pile of cash sleeping in a vault. Imagine a living system. A system of promises, a system of motion, a system that only works because almost everyone believes it will.